What's going on, everybody? Welcome into the Tuesday, January 28th, 2025 edition of the Daily Energy Newsbeat. Stand up. Here are today's top headlines. First up, Trump seizes wartime powers in battle for more fossil fuels. If you are a fan of The Office, this is equivalent to the meeting of the five families. So we got to love it. Next up, Europe doesn't need U.S. gas, but it might buy it anyway. A very interesting deep dive into the LNG market there in Europe. I will then jump over and quickly cover what happened in the oil and gas markets today. And holy smokes, if you ever thought China wasn't in the news until today, DeepSeek absolutely crushing stocks. Theoretically could be impacting prices on the oil side, but I think there's some other factors in there. And then we have our first earnings beginning to drop for Q4 2024. First up, oilfield service. We'll talk Halliburton, which posts quarter-on-quarter income rise, but there is some detail together moving forward from there. But Stu is out on assignment. He's actually en route to the great state of Texas. We're doing a little in-person team. We've got our other team member sitting in the other room right there, so we are fired up. But I am rocking a solo show today, guys. Let's go ahead and dive on in. All right, first up, Trump seizes wartime powers in battle for more fossil fuels. This is pretty interesting. As we all know, in the first week of the President Donald Trump's second term, he declared an energy emergency, which really what that does is that opens up the door to basically little-known authorities and, really Cold War era powers that were set way back when, which allows both fast tracking of pipelines, power grids, and to save struggling coal plants. I point out that in that first paragraph that I just read from a little bit, okay? Never did it mention increasing oil and gas production, which has been my drumbeat the whole time. Drill, baby, drill is not necessarily increased production, but increased transportation. Okay, that's okay. Basically, what he's done is that he's told all of these agencies, the EPA, the Department of Interior, NOAA, that to basically scour all different statutes and regulations in an attempt to find obscure rules which do allow him to facilitate the production of more oil, natural gas, and electricity, also as well as approve construction of pipelines and power lines that are needed to move that to its end consumer. So, yes, there is a little bit of, hey, we got to increase oil production, but I think he's realizing, and it's only been a week now, so we'll see where we are in a month, but I think what he's realizing is it's going to be a little bit harder than I think to actually increase production. But what I can do is get new pipelines, new electrical lines, and I can get these LNG export facilities approved, which we'll talk about a little bit in the next. Here's a quote from Kevin Book. He's the managing director of a Washington lobbyist from Clearview Energy Partners. This is power politics in an era of power, not rules. Super interesting quote there. Again, a lot of this does come down to politics. And really the reason why, and this is the other thing, he's ordered going back to, if you're in office, the meeting of the five families. Trump has ordered quarterly meetings of a committee of cabinet level officials that's authorized to greenlight ventures even when the survival of species is at stake. And when they mean species, they mean like the occasional rodent that's running through your backyard right now. This panel, which is known as the God Squad, has actually only met a handful of times over the past 4 decades. Again, a meeting of the five families. I absolutely love it. We've all known that industry leaders have complained for years now that these conservationists have weaponized the Endangered Species Act, and I think that's also part of the thing here. Elon talked about it with having to put headphones on seals just to test. I mean, again, I think that seal was more traumatized than he would be with the takeoff. It's pretty unbelievable. Most of these emergency powers that are in federal law are designed to rapidly halt action, which is interesting. So the question is, are we going to be able to use it to kickstart? Again, the president is allowed strong emergency powers, so it's going to be very interesting to see. Final quote here from the article: Dina Wiggins, president of the Natural Gas Supply Association. Man, there's these lobbyists from all over the place. We desperately need more pipeline infrastructure to the Northeast. There's quite a bit of gas, but we can't get it through the state of New York. So again, I think what he's realizing, something that I've been screaming at from the top of my lungs, this is a transportation issue, not necessarily a production problem. But speaking of transportation, let's jump to the next article. Europe doesn't need U.S. gas, but it might anyway. Interesting. So what Donald Trump here is talking about is pushing EU countries to buy more U.S. shipped gas. there are reasons that Europe, as this article says, is considering taking the bait, but each of them come at the price. High line, top line is, basically it's a price that could be, it's a way for smoother relations with the United States. I'll kind of read the top line, kind of the big bullets, and then we'll dive into each one. So one, they're saying that this is a price Europe's willing to pay for smoother relations. Interesting. They're also saying that new dependencies and the lessening climate concern has led them to this, and also their de-reliance on specifically piped gas from Russia. So, at a top line, I think what they're saying is, hey, yes, Europe would love to take U.S. natural gas, and there are reasons for that. But at the end here, what it basically says is, well, there may be more at play than just that, because they may not actually need the LNG, and that U.S. and specifically EU demand for LNG may have already peaked. So guys, give you an idea, to this day, the U.S. currently exports about 50% of its LNG that flows through its export facilities to Europe, and imports of U.S. LNG has filled all of the factories and allowed them to kind of stay up and running since the 2022 invasion. But the EU gas consumption since 2022 has tumbled 13.3% and 7.4%. Leading analysts to wonder, have we seen peak gas demand in Europe? I actually take the other side of the argument and say, well, it's because prices have risen so much to where people are cutting back. I mean, it's so cheap. Energy is so cheap here, specifically in Texas. And I leave my lights on when I leave. I keep my AC on or my heat on, depending on what time of year it is. But that's because I'm paying, 6 cents, 8 cents a kilowatt hour. If I was paying $1 per kilowatt hour, yeah, I'd probably have things shut down. I wouldn't have 9 screens in front of me, TV going in the back, heat on, AC, flipping to AC and heat back and forth. I would, again, the free market, the supply and demand curve, when prices rise so high, we see demand fall, which then shifts price down, or which then shifts supply down, aka falling gas consumption. So I don't necessarily know if this is a trend. I think we need more than 2 years of data, especially since in 2022, it's been a little crazy with the war. But we did see in 2024 that that LNG imports to the EU did decline to the previous year, which basically there was a network of LNG terminals along Europe's western coastline that went fairly underutilized. We also did see a warm winter and a weakened economy. Again, a weakened economy. I come back to the warm weather. Some of that's out of control, so maybe it was just 2 warmer winters that we needed. We was actually a little cold, not in 24, but in 23 and 22 it was really cold. So again, interesting counterpoints here. And then, the other side of this article points out is the supply side. We talked about the demand side, but the supply side of that, if the IEA is correct, they're predicting a global glut of gas, which is 50% more LNG that should be than will be needed around the world by 2030, which is mainly driven by the expansion both in the United States but also Qatar. So very interesting there. It goes on to talk about, I mentioned, the counterpoints to the rising demand, or the lowering of demand and rising of supply, which is, both highly cyclical, is that they may just go back to U.S. LNG specifically for smoother relations with not just the Trump administration, but with the United States, and also the lessening effect of climate and climate concerns. And we've known about these LNG deliveries for long. Qatar is signing 30, 50, 100-year deals to supply gas. So I think this is very interesting. It's a great breakdown, in my opinion, of, yes, the EU probably does want U.S. gas, but will they need it, and for how long? And, obviously things change, and you need to be planning 30 years in the future. So, some of this stuff, taking a lot of the short-term data and trying to extrapolate it, I think can be interesting, but we will see that. Let's go ahead and jump over to finance. A lot to talk about there, but before we do that, guys, we got to go ahead and pay the bills. As always, thank you for checking us out here on the world's greatest website, www.energynewsbeat.com. Stu and the team do a tremendous job making sure that site stays up to speed. Everything you need to know to be the tip of the spear when it comes to the energy and the oil and gas business. Go ahead and hit that description below for all the links to the timestamps, links to the articles. Also, check us out on Substack, theenergynewsbeat.substack.com. It's the best place if you want to support the show. Give us a follow there. Sign up for a paid subscription for access to all of our exclusive content that we only put there. It's not available on Energy Newsbeat. It's only available via Substack. Go ahead ahead and sign up for a subscription. We appreciate all of our current subscribers and paid subscribers there. You guys are really the ones that are keeping this ship afloat. As always, guys, if you are interested in becoming Billy Bob Thornton from Landman, and you're, and I say that tongue in cheek, really what you should be doing is slightly becoming Billy Bob Thornton from Landman. But you should be planning your 2025 cash flow and tax burden, and you can do that via oil and gas. We have some great resources. If you want to learn more about how to do that, go to investinoil.energynewsbeat.com, and you can sign up for all of our info. One of our partners who's sitting in the other room, he's got a great ebook that he has co-authored with a few other people, me being one of them, that gives you a great overview of about what's going on and some of the nuances of investing in the business. And this is mainly designed for non-oil industry experts. So if you've never invested in oil and gas, it's a great resource. If you have invested in oil and gas, we have some other resources, specifically our Deal Spotlight podcast, which kind of talks about how we think about due diligence and how you might need to think about due diligence as you're looking at other projects. Again, that's investinoil.energynewsbeat.com. Save money on taxes, increase some cash flow, and ultimately become Billy Bob Thornton from Landman. I mean, let's look at the markets here, folks. Absolutely red across the board. I'm looking at the tickers, and it's, my eyes are starting to bleed by how much red I see. S&P 500 down 1.8 percentage points. NASDAQ down a whopping 3.28 percentage points. Don't look at your 401k, folks. U.S. 2-year treasuries down 1.4 percentage points. U.S. 10-year treasuries down 1.8 percentage points. Dollar index, oddly, is actually fairly flat. Bitcoin down 3.8 percentage points. It's below 100,000. Not sure how correlated that is to what we'll talk about specifically in the next upcoming here, but crude oil down 2.3 percentage points, just above $73 at 73.06. Brent oil only down about 0.8 of a percentage point, 76.98. Natural gas down 9.4 percentage points, a whopping 37 cents, down to $3.64. Our XOP, which is our EMP security contract, 2.2% down on the day, down to 137.56. Unbelievable. Top line, articles will tell you, and what's really going on the broader stock market is this news out of China that DeepSeek, which is a ChatGPT, OpenAI, competitor, basically has dropped a new model that basically is like 100 times cheaper than OpenAI. They only spent a couple $1 million building it when, billions have been spent on U.S. infrastructure. We've been talking about the Stargate program all last week, and they basically dropped one for $1 and said, yo, look what we did. And it's beating all benchmarks. It was so well searched, they blocked new users from signing up. I couldn't sign up this morning. I was like, I need to see what this news is on DeepSeek, see how good it is. Tried to sign up. Couldn't, because they're just having issues with it. Has absolutely tanked the economy. And part of what that shows me is that the economy has been run up by the fact that, AI is going to change the world. And we've all been under this assumption that it's a huge CapEx problem. I mean, look, they're talking about it on CNBC right now. Big tech CapEx worries. I mean, you couldn't have timed that any better. I promise you I didn't time that. But seriously, guys, the CapEx problem that's going on right now in the United States, or I don't want to say problem, I wouldn't specify it as a problem, but the assumption that you just need to spend hundreds of billions of dollars in order to train these models have kind of been blown out of the water with DeepSeek. So that's what's going on in the broader economy. In terms of oil and gas, the real big issue is what was going on at the World Economic Forum last week, where Trump has basically outwardly said, OPEC, I need you to reduce oil and gas, or I need you to increase oil and gas production. On top of that, we're also seeing some weaker economic data from China and tariffs. We went back and forth on Friday, as Stu mentioned, with Colombia refusing a plane, then not refusing a plane, then more tariffs, then some tariffs, then no tariffs. We haven't seen OPEC Plus yet respond to Trump, and the assumption is they're going to keep it the same. But the quote from Bob Yeager, he's the director of energy futures at Mizuho. President Trump continued to put pressure on OPEC, calling on the producer group to lower price, help end the Russian war in Ukraine. Not sure if that's if that would help end the war, but it definitely might. To give you guys an idea, Colombia, speaking of the Colombian tariff, Colombia did send about 41% of its seaborne crude to the U.S., so that's kind of interesting there. Here's another quote from, I'm going to butcher this name, Bajar Shaldrop, chief commodities analyst at SEB. There's broad-based negative sentiment in the market, even if sanctions didn't take place. This is still nervousness that Trump will bully whoever he needs to get his way. Another Citibank report says this weak readings highlight the need for more policy efforts to stabilize economic growth. That's talking specifically about manufacturing data coming in weaker in China. So all in all, markets just having a thrashing today, mostly again on this DeepSeek news, but also I think some of the fundamentals, or at least the potential of fundamentals changing from a supply and demand point for what Trump is doing, is starting to hit ahead here. And we're seeing prices fall as we speak. We got to jump in and start earnings. Q4 earnings are here. We always start with oilfield service, and today we get Halliburton. They post quarter-on-quarter income rise on a net income of $615 million for the fourth quarter. That was actually compared to $571 for the third quarter of the year, though it was actually below its $667 million quarter reported from a year ago. So they're actually down year over year, but up quarter over quarter. Usually I like comparing year-to-year quarters versus, Q3 to Q4, because cyclical in terms of, companies maybe, in the oil and gas space tend to spend more in Q4 than they do in Q3, especially because they find out if there's a surplus or low on budget, or they're trying to hit production targets. There's a lot of that stuff there. So generally you'll see Q3 softer than Q4. So the fact that Q4 2024 was down from Q4 2023 shows me that things have softened a little bit. Total revenue for the year was 22.9, which is actually, or 22.9 billion with a B. That was actually flat year over year. Operating income was 3.8 billion. Compare that to 2023 on a full year at 4.1 billion. Net income attributable to Halliburton for the full year landed at 2.5 billion, which was below the 2.64 billion that was reported in 2023. CEO, President, Chairman Jeff Miller, I'm pleased with our performance in 2024. We had generated 2.6 billion of free cash flow and a return of 1.6 billion of cash to our shareholders. While we expect 2025 to be sequentially softer in North America, we began the second half of this decade in great position with transformed balance sheet, leading returns, and strong cash flow. So again, I take out of this, oilfield service does a better job of predicting demand than oil and gas operators, because their revenue in the oilfield service side absolutely depends on it. Yeah, oil and gas company, what they do this year really affects next year. They aren't as accurate as somebody who is in the oilfield service space. So, it's pretty interesting. Halliburton coming in, they did drop a little bit in terms of price, in terms of their stock. They're down about 0.25 percentage point is the time recording here. So obviously they're taking it in the shorts here, but it'll be interesting to see how they jump in. And obviously with that softer 2025, we will see. But with that, guys, I'm going to go ahead and let you get out of here, get back to work, start your day. As always, thank you for making us part of your Tuesday. For Stuart Turley, I'm Michael Tanner. We will see you tomorrow, folks.